So today I want to talk about TradeSpoon signals, and I want to talk about how to trade option spreads using TradeSpoon signals, and especially in the market volatility like we had this year, where VIX is going between 16 and 24 in a matter of a couple of days. It's very important to have a simple strategy and like options, and specifically option spreads, and be able to design strategy in such a way that you don't lose money in volatile markets. Also, thank you, Reed, for the introduction. Thank you again for having me, giving me the opportunity to present. I was the chief technology, a little bit about myself that Reed already went over. I was the chief technology officer at Options Express. I was working there from its inception. And my passion is to work for different startups. Here in Chicago, I worked for hedge funds. I worked for online brokers. And for the past 3 years, I started TradeSpoon because it gives me an opportunity to trade my own money, manage my own money, and build technology using quantitative trading, using programming to find opportunities in the market and make a simple strategy that on a daily basis can tell me what are the best stocks to trade. So some of the disclosures before I get into the presentation: options do involve risk and not suitable for all the investors. Prior to buying or selling an option, a person should consult their financial advisor, and you can go to Option Clearing Corp to find out all of the risk associated with trading options. Presenter of this video and the team at TradeSpoon may have financial interest in some of the securities presented in this presentation. So when I started at Options Express, we were encouraged to trade, and I quickly realized that I can be correct on the direction and I can be correct on the market, but short-term volatility like we had this year can stop you out of your position very quickly. And the worst thing is that if you don't have a good trading plan and you don't trade often or trade small, you tend to chase the market because the market goes one way, you got stopped out of position, you think it will reverse, and you either over leverage or you don't have enough money to put into the trade, and you tend to chase the market. So it's very important to have a specific trading plan. We had a lot of trading psychologists come to our presentations at TradeSpoon, and the biggest issue that they've noticed was the investor retail community is that lack of trading plan, that you either over leverage your capital, you won't put in too much money into any single trade, you don't have a specific trading plan that tells you what is your stop loss or what is your target gain, and how to calculate that in advance. And that becomes an issue. So I quickly learned that, and the one thing that I learned is that in the beginning when I start trading, I'm chasing the market and I don't have any technology or any ways to predict where the stock prices will be. And there is a lot of you hear a lot of presentation, there is a lot of technology out there that analyzes technical charts. But technical charts is the information about the past. You have to look at the technical charts, find the key support and resistance level, and then predict where the stock is heading, or an index or a currency is heading into the future. So at TradeSpoon, we designed a system that predicts where the stock is heading in the next 75 days. The idea is that it's simple to use, it's a single strategy, and you only need 15 minutes a day to review your existing positions or get into a new trade. So here's the TradeSpoon system. It's built based on neural networks, and the most common question that I get, what's the difference between regular technical analysis, looking at Fibonacci retracement, looking at moving averages, looking at different key support and resistance level, and the system that you have? Well, the difference is that our system is using neural networks, a kind of artificial intelligence, to analyze prices and earnings of all the stocks in ETFs in the past, before the earnings and after earnings for the past 25 years, and then assign a score that you see on your screen, this long-term rating score and a short-term trend score, to see what is the best of the opportunities in the market today. So we tell you what stocks to trade. A lot of the systems, you basically have to pick your stock. And a lot of people say, well, I'm looking for liquidity, I'm looking for volatility, I'm only going to trade Apple and high beta stocks. I'm going to trade Apple, I'm going to trade Netflix, and I'm going to trade Twitter, and I'm a day trader. That's great. But Apple and Twitter can be great to trade today, but tomorrow it might not follow the trends. It might not follow the system. And whatever your system is, whether it's Fibonacci retracement or Ishimoku cloud that is very popular now, but they are all mathematical equations that always look basically at support and resistance line, and they have a simple math that tries to predict the setup based on historical data. But these setups don't backtest, they don't go back in the previous test, and they don't analyze time. The difference between our system and most of the other technical systems is that we have an artificial intelligence that trains on the data, just like humans do, and then makes decisions on which stocks to trade, and it analyzes time. And it says, and it predicts what is the best stock to trade today, and what will the stock be in the next 10, 20, and 30 days? What will be those key support and resistance levels are? And that's where we are different, is that we are using R scripts, and we are using MATLAB, and we're using artificial intelligence to predict, based on earnings and price action around the earnings for any given stocks, what the best stock to trade. And as you see on your screen, not only tells you whether the stock is going to be higher or lower in the next 20, 30 days, but what is the probability of that event, and what is the accuracy. If you go back and you backtest this for the past 25 years, what is the accuracy of predicting, United Armor or TAP being higher in the next 50 days or in the next 30 days? So by making that prediction and backtesting and assigning accuracy, we are telling you not only which stocks to trade, but what is the key support and resistance levels are for those stocks and where the stock is heading. So here's the screenshot of stocks we're analyzing all of the NASDAQ, New York Stock Exchange stocks, and all of the ETFs that trade on AMEX. A lot of people ask, do you trade currencies? Do you trade commodities? This system will analyze ETFs, so you can have currency or indexes that trade on AMEX as proxy for futures, if you're a future trader or a day trader, to find these key support resistance levels. So I know you guys, a lot of you guys have questions, so do me a favor, type in the questions inside of the chat box. I'll make sure that I address them at the end of the presentation. But I'm going to try to go through the initial presentation as quickly as possible. So what you see on your chart, on your screen, is that you type in a symbol such as Morgan Stanley, and we are showing you the annual seasonal chart. We will show you the current year chart and predicted chart, predicted prices chart. So the blue and red bars that you see on your screen, and let me draw this out so you guys can see. So this is your current chart of what happened to Morgan Stanley in the past, January and February. And this, the predicted price, is what the prices are for upcoming 10 days. And we show you the support and resistance levels are for upcoming 10 days with 96% accuracy. So there's very high accuracy in these 10-day predictions where the key support and resistance are for Morgan Stanley. And I just did it before this webinar. So we predict that Morgan Stanley will trade between $33.96 and $36.69 in the next 10 days. We also predict where the Morgan Stanley is going to be in the next 20 days, 30 days, 40 days, and 50 days. For those of you who trade regular options like we do, we follow regular monthly expiration, or if you trade weekly options. So we give you these analysis, and this makes the system very easy to use. Why is it easy to use? We are making sure that not only we're telling you what stocks to trade, we're only going to give you 2, 3 stocks every week that have the highest probability, but we also tell you what the key support and resistance level are. And if you're an option trader, you can easily, just by looking at this chart, say, well, I can test this. If Morgan Stanley is going to trade not lower than $34 in the next 20 days, I can trade weekly options, or I can trade monthly options, and I can sell, because I believe that Morgan Stanley is heading higher. I can sell a put spread, right? I can sell a 34 put and protect myself with the 31 put. Or if I'm a more aggressive trader, I can actually do an iron counter and I can sell a 34 put, but I also can sell a 37 call. So it's a very easy system. You look at this chart, you know right away what strategy you can execute based on your comfort level. Or if you're a stock trader, you can buy a stock and sell it, buy stock for $34, sell the stock at $36, and it makes it very easy. So before you Before we get into how to execute call spread, kind of the topic of today's presentation, you have to make sure that you actually understand, this top-to-bottom approach. You have to understand where the market is, and you also need to know not where the stock market is, but what stocks to trade and what the key support and resistance level are. So let's get into this let's get in some of these examples. If you're a TradeSpot subscriber, you basically, before you execute your call spread strategy, you go to my tools, and we have different tools for traders. Today we're going to talk about TradeSpot Bulls. So you click on TradeSpot Bulls, and let me erase some of these drawings. And if you run, I like to run 9s and 10s. So you can actually see, here's the 17 stocks, and if you want even less, you can just do 10s. Here's only 9 stocks. So here's 9 stocks where long-term trends. This is our first model, neural network model, that predicts long-term rating on the stocks. It assigns a rating on the stocks based on our models, and 10 means we're very bullish on the stock. 9 means we are bearish on the 10 and 9 means we're very bullish on the stock. Rating is a long-term view using the discount cash flow analysis, prices, and earnings. And trend is, again, the short-term trend that predicts where the stock is heading for the next 50 days. So we're looking at, let's say, Starbucks, and we're seeing that the Starbucks, after the great earnings this quarter, it's heading higher. In the next 20 days, in the next 40 days, and 50 days, we see that the probability of Starbucks being higher, and we also seeing long-term rating. So short-term trend is very easy. It's the prediction for the next 50 days, purely based on price and earnings. And rating is basically how the stock is relative to other stocks in terms of discounted cash flow analysis and earnings and price. And if you want to see the chart, seasonal chart, it basically will show you for Starbucks where we think the Starbucks is heading in the next 50 days and what are the key support and resistance levels are for Starbucks. So here's the Starbucks. So, and again, for Starbucks, we see that in the next 10 days, at $83, $82.60, that's a support. And overhead resistance is at $84 for the next 10 days. And we're seeing that our predictions for the next 20 days, the stock will be higher, 30 days it will have a sell-off, 40 days higher, and 50 days higher. And the seasonal chart shows you, just looking at the seasonality of Starbucks, going into April and May, Starbucks consistently for the past 25 years moves to the upside. And not only it moves to the upside, you can also see the correlation. Right now it's 54% correlation of how the Starbucks moves today, this year, versus its historical data and historical price movement. So by looking at the seasonality chart, that's this guy. Here's your seasonal chart. By looking at the current year, that's this guy. And by predicting the prices, that's this orange line, or orange price, you can actually find out very quickly for any ETF or any stocks where the key support and resistance are. Here's your overhead resistance, and here's your support line. So now once you can easily spot which stocks to trade and what a support and resistance level are, the next thing is to pick the right strategy. Simple strategy that you can use. If you have a bullish view on Starbucks, what is the simple strategy that you can use that can actually withstand short-term volatility in case market does sell off due to geopolitical risk? Maybe Greece will exit the European Union tomorrow, then the stock will sell off. And it could be a short-term volatility or it could be long-term volatility, but you want to build a strategy that if there are geopolitical news and you have a short-term volatility in the market, you can withstand those events quickly. So let's go back. So At TradeSpoon, we advocate, simple strategy. We either do stock trades or an option trades, and not only we trade our own money and we trade our system, we will provide you with daily recommendations, and you can actually see it here. If you're TradeSpoon subscribers, not only we provide you technology, but we actually run in a portfolio where we manage our own fund, and we exposing these trades every single day to our subscribers. So we recommend North Grumman, we recommended February 6th, on February 4th we recommended Triple M, on February 2nd we recommended CVS, and if you look at any of these stocks, you can actually see that we are telling you what is specific entry price you have to get in for each stock, what is specific gain and loss we recommend. If you're an option trader, what option call to trade, and if you're a spread, we will tell option spread trader will tell you whether to get into a debit spread or a credit spread, put spread or a credit or call spread based on our ratings of the stock, based on these long-term ratings of the stock that you can actually see here. So you click on probability calculator, and you can actually see that for CVS, here's our forecast for the next 50 days, whether it's going to be higher or lower, and we actually provide you what is the probability of stock being in a certain price range in the next 50 days. So once we do that, what is the so now what is the call spread and what's put spread? And today, since we don't have a lot of time, I'm just going to talk about bullish call spread because the market is going to the upside. But the idea is that if you're bullish, you can execute bullish call spreads, debit call spread, or you can do credit put spread. Or if you're bearish on the market or on a specific ETF, then you can buy a debit put spread or sell a credit call spread. But we're going to go over only one strategy, and the other strategy are very similar. We're just not going to have enough time to get into all of them. So let's go through that. So if I'm bullish on CVS or on Starbucks, the way the model showed me and with the key support and resistance levels are, if the volatility is low, right after Starbucks already made earnings announcements, Morgan Stanley already made earnings announcements, after then volatility collapses, that means options are cheap. If options are cheap and I have a bullish strategy on the stock, like Morgan Stanley, I want to execute what is called bullish debit call spreads. I'm paying money up front and I'm buying options. Why am I buying options? Because options are cheap. Why options are cheap? Relatively cheap, speaking to their historical volatility. They're relatively cheap because binary event has passed, such as earnings, and volatility, implied volatility collapsed, and options are cheap. So when options are cheap, we buy them. If options were expensive, we were getting close to the earnings, and right before the earnings, then most of the time we would not buy debit call spread. We would sell a put spread away from the out of the money put spread because volatility is high, and it makes sense to sell options premium when volatility is high because you have a lot of option volatility and your risk to reward ratio warrants that. So debit call spread, we're buying Morgan Stanley debit call spread, or we're buying Starbucks debit call spread because they announced earnings already, and the reason we're doing debit call spread because low risk, low reward profile. Trade gives up some upside potential in exchange for the chance to recover premium. Cheap strategy compared to long calls. Specifically, once you trade, once you see there is a high probability of stock being between, like CVS, between 93 and 107 based on seasonal chart or based on implied volatility or whatever the model is, it makes sense. If you believe that CVS will not go above 107, it makes sense to, and implied volatility is low, it makes sense to buy 100 call and sell 110 call or 107.5 call because the probability of 107.5 strike being at the money in the next 50 days is only 14%. So when you trade options, you always have to look at the probability, and that's why we're adding this probability calculator, because you want to sell out of the money options. You are limiting your upside because if CVS all of a sudden jumps to 120, 130 level, then you're limiting your upside, but you got to look at the probability of that event. If that probability of the event is only 14%, then you know that 9 out of 10 times it will not go above 107.5. If that's the case, and especially there is no binary event such as earnings, sell 107.5 call, collect that premium, you lower in your cost basis, buy 100 call, in the money call, and you're reducing your cost basis. You reduce your cost basis, that means you're improving the odds of being successful. So trading is just like, it's very statistical process. You have to look, especially options, and so do stocks. When you trade options or stocks, you have to look at the probability of stock being at a certain price level. And if that probability is low, such as reaching 107.5 level for CVS, you want to sell that call because 9 out of 10 times you will be correct. Just like when you roll 2 dices and you betting on 6 or 8 to come out, you know that probability of 6 or 8 coming out on rolling 2 dices is 12%, right? You can bet on 1 and 1, and you can bet on 6 and 6, but they will only come out 1 out of 36 times. So the probability of that event is very low. You don't want to bet on having 1 and 1 because 1 out of 30, 35 out of 36 times, you will lose money. Of course, you can get lucky and have it 2 times and 3 times, but statistically speaking, if you do this over and over and over again, and you trade small and you trade often, and you do it over a long period of time, over years, not over days, you have to look at the statistics of each of the trades. And if statistics of 6 and 8 is 14%, then you are betting on 6 and 8. If you're betting against 7 and you don't want 7 to come out, you know that probability of 7 coming out when you roll 2 dice is a lot higher. Not a lot, but it's higher than 6 and 8. And you know that 1 out of 4 or 1 out of 5 times 7 will come out. So you don't want to bet consistently against 7 because you know at some point 7 will come out. It's the same kind of idea with trading. Trading is driven by statistics. Market makers are using statistics to predict, to price options. So the prices of options already reflects the implied volatility of the options, and it reflects the premium that market maker wants you to pay. And these probabilities are arrived at those, are calculated and have very high statistical chance of being, there's a very high statistical chance that CVS will not be at 107.91 in the next 50 days. So if that's the case, you want to structure your trade in such a way that you're selling option premium at 107.5 and collecting that money. So this is a very important part. So trading setup for bull call spread, as we already just covered, you buy in the money call option and you sell out of the money call option. And you do it on the same underlying asset with the same expiration time. So just like we showed here, if you're, for TradeSmooth subscribers, we actually do that. It's kind of part of our premium service. Every day we provide you with a recommendation. And every day we tell you what option spread to trade. And here you're seeing that we're buying, let's see, this is CVS. So this is a put spread, so let's look at the call spread. I think this is here. Let's look at the Morgan Stanley. We recommended Morgan Stanley on January 27, and I believe it was a debit call spread. Yes. So here's a perfect example. Morgan Stanley, we recommended on January 27. Here's our rating. And what we did was we bought 35 call, right? We bought at the money call at that time, and then we sold 38 call, right? So this is a debit spread where we bought at the money 35 call, and we sold 38 call out of the money. And that's the structure of the trade. Sorry, just 1 second. Let me go back to that slide. Okay, so the profit and loss profile looks like this. You are, which is very important, you're buying in the money call. So this is your long strike. In the example of Morgan Stanley that we just did, you're buying 35 call. So this is the maximum loss you can have if the stock drops below 35. And the maximum gain is at your short strike. And that's your 38 call. So this is very important to understand. This is your $35 that we just went over in the example of Morgan Stanley. And we're sold 38 call. And this is where your maximum gains are. But that's okay. We're limiting our maximum gain because the probability of that event is small. So it's okay to cap that, especially if there is no binary event in front of us. So this is where you sustain maximum losses, and this is where you can get your maximum gain. So as long as you're correct on the direction of the stock and on the timing of the stock, and the stock reaches $38, this is your maximum gain, and this is your maximum loss. For an option trader, it's very important to understand profit and loss charts and making sure that you structured your trade in such a way that you can maximize your profit. So calculating the cost of the trade with bull call spreads, you pay the cost of the purchase call closer to the market price, and you earn from the sell and the call spread. So the total trading cost is difference between the amounts paid and earned. And you can see it here. So the maximum gain for this spread is 102. You paid $1.30 for 35 call. You sold 38 call, paid 28 cents. So your maximum gain for the debit call spread is $1.02. And your maximum gain is the difference in strikes. So 35 minus 38, 35 minus 38 is $3. $3 minus $1.02. The maximum you can actually gain is, in this example, is $1.98. But we're at this junction we basically limited our gain to 1-to-1 in terms of gains and loss. But this is how you calculate the cost of the trade. And the maximum risk occurs at the lowest price. So an example of 35.38 call, if the stock drops below 35, that's where you sustain the maximum loss. So it's the original debit that you paid for your debit call spread. So here's again, just to recap, long strike call is where you sustain maximum loss if the price drops below that, and Morgan drops below 35, and the maximum gain occurs at the short call strike. If it reaches 38 or above, that's where you sustain the maximum gain. So maximum gain, we already went over it. You look at the difference between the strike prices minus the debit that you paid. So in Morgan Stanley, we took at the difference between long call and short call, 35 minus 38, that's $3, and we paid, and we took the difference between the two. So just to recap, profits are the difference between the strike prices and the initial trading cost of the trade. So if the prices move higher, as expected, the losses from the sold calls will be deducted from the gains. So the whole point of selling out of the money call is to your cost basis, your original debit that you have to pay. And you do that because the probability of stock reaching the strike price of the short call is small. This is why we personally prefer to trade option spreads. And a break even occurs when the stock reaches the price of the debit that you paid. So some of the examples here that we went over with XYZ, we actually, let's recap the example that we did with Morgan Stanley. Morgan Stanley, at the time of the recommendation, was at $35.11. We bought at the money call for $1.30. We sold 38 call for 28 cents. We paid $1.02. The maximum loss is the debit that you pay. The maximum gain is the difference in strikes. 38 minus 35 is 3. 3 minus $1.02 is $1.98. But according to our profile, we'll never seek for profit of more than 100%. If it reaches, great, but that's kind of going back to our trading plan. This is how we structure our trades. So here's another example of WDC position where the current price is 102.26. The earnings were on January 23rd. Here's our long-term rating of WDC. And again, the example that we did, and looking at the probability curve here, how to make the maximum profit for that. So in conclusion, credit and debit spreads provide traders with some alternative and more advanced strategies that allow for limited risk and protection from highly volatile stock market. That is the most important. If Morgan Stanley sells off tomorrow because Greece will exit the European Union, but this short-term volatility will only last a week or two, or if they don't exit, but there is a high, people think they're exit, the Morgan Stanley will sell off maybe for a couple of days, but then the prices will go back. And as long as you're right on the timing and usually structure our trades 50 days or more, you will make money. So it's very important to have a trading plan. That's what we kind of started our presentation at. What we did at TradeSpoon, not only we provide you with a trade recommendation, but we actually manage our own money and we show you all of our trades. We believe in having a plan and being able to go back to trades and look at our losses and look at the winners. So we're exposing all of the trades that we do, one trade a day, and you can go back and actually review what the trade was, what was the volatility, implied volatility rank, what was the return on capital, what was the probability of success of our trade, what was the estimated move. You can analyze it and you can see how to structure your trade, because as you get more and more experience and you trade often and you trade small, the idea is that these ranks, these probabilities will change. More experienced trade, they sell out of the money options, right? So on Disney, they will sell 112 call because there's only 7% chance, or they'll sell 92 call. And that changes your risk profile, right? The higher the probability you're taking, the higher risk you're taking. The high probability events occurs only if you're willing to risk more, you're risking more money that you're getting in return. So as more experienced trader, they're looking for high implied volatility and they're looking for higher return on capital with smaller return on capital, but with a higher risk. The new traders, when you only start trading stocks or options, you want to structure your trade that you're closer to at the money strikes, but you're risking less money and you can win more money because you don't have experience managing positions in a volatile market. So I encourage you to look at our performance. We show you performance of every single trade. We also do backtest results. We do in what-if scenario. If you open up an account with $10,000 and you're putting only 5% of your money in each of the recommendation, that's what we're advocating, no more than 3 to 5% of your portfolio should go to any given trade, then you will see from the inception how did your portfolio would have changed. You start with $10,000. This would be the portfolio in December 2012, and this would be the portfolio in February. So you're returning 180% over a period of 3 years. This doesn't take into consideration commissions or slippage, but this is a trading plan. The purpose of this is, A, for you to get comfortable with our performance and what we've done in the past and our trade recommendation, but also come up with your own plan. Maybe you want to take less risk. This is too aggressive of the trades. Then you trade less often, or maybe you want to adjust your probability of success. But when you adjust your return on capital and probability of success per trade, then you'll know how much profit to take on any given trade. And if you don't have a trading plan, if you don't record how much you're making per trade and what is your target gain and loss for any given trade, and you're chasing the market, this is when you sustain most of your losses. You're a lot more profitable and you can grow your portfolio a lot better if you trade with, you're only allocating 3 to 5% of your portfolio into each trade, and you know exactly that you're looking for 15% return on any given trade in 20 days, which is great. But same thing with the stop losses. You never lose more than 30, 40% on your any given trade. And as long as you have 67 or 70% ratio of winners to losers, here's the ratio of winners, here's the ratio of losers, you can grow your capital. And this is a back test, but maybe not going to grow at 180% or 50% a year, but you'll grow 20% a year, you'll grow 30% a year. And if you only spend in 15 minutes a day on each of the trade, then it's a great strategy to do. So if you have, we do have a special. I know I only have a couple minutes left, but we wanted you to try our system. You can try it for free. There's no long-term commitment. Just try it for free. You can go to tradespoon.com weekly and type in any symbol to analyze what our view on a stock or ETF is. If you go to tradespoon.weekly, you can actually launch the Tradespoon Weekly idea, and we'll give you 3 free trade ideas. This is every week we get the results of our models, and we'll show you based on our models what are the 3 stocks that will outperform the market for this week. And you can look at the seasonal chart for these stocks. You can actually type in any symbols that you want. You can type in, if you're, for free, you can go in and basically go to the seasonal charts and type in spiders, let's say you want to analyze what we think are the key support and resistance levels for spiders, then you can see that we think that spiders will be at $2 or $3. That's the overhead resistance, and here's the $199 overhead support. Or if you want to type in USO, you want to look at the oil, you can type in USO ETF, and we will tell you here's the support and resistance levels for the next 10 days for the USO. And this is free, so I encourage you to take a look at this, type in weekly, and take advantage of our offer. The idea is that, for you to get comfortable with our system, with our prediction and accuracy of our predictions, and then if you do want to upgrade to a paid subscription and you actually want to know every given week what are the highest trades to trade, then, and looking at our portfolio, then you can upgrade into a paid subscription. But if you don't, if it doesn't fit your profile or it doesn't fit your style, then you basically just use it for free. So I'm going to type this here, tradespoon.com weekly, and put it in the chat box. I'm also putting in the questions. So do me a favor, if you guys trade in market, stock, options, commodity, I think you should try it out. Go to tradespoon.com weekly, try it out, try our weekly ideas that we just computerly generates based on the statistics, but also type in any symbols, any stocks that you're trading or ETFs or commodities, enter ETF symbol or stock symbol and see what our predictions are.